Hello class, let's talk about tax incidence. Tax incidence refers to the case where a per unit tax is introduced into the market. This per unit tax can be given to the consumers or the suppliers, depending on the situation. However, in either case, both the supplier and the consumer will end up paying a portion of this tax. Hence, the term tax incidence. We want to know how much the consumer pays and how much the supplier pays. If the tax is given to the consumer, what we will see is that demand will be negatively affected in this case, meaning it will shift to the left as shown. This will give us a new equilibrium, which is shown here. But now we will have 2 points to assess, because at this equilibrium price we still have to put in or add the per unit tax. Similarly, if the tax is given to the supplier, supply will shift to the left, and again we end up with the same situation of having two different prices. Shifting supply and demand to analyze what happens in the market when a per unit tax is introduced can get very confusing. For example, you have to decide how much to shift your supply or how much to shift your demand. For this, there is another method that is more intuitive to analyze this type of situation. It is called the wedge method. Assume that there is a tax of $1.50 instituted into this market. Now, it doesn't really matter who the tax is implemented on. We know that both the supplier and the consumers are going to have to pay a portion of it. So, what we simply do is figure out an opening or a wedge between supply and demand that measures $1.50. Here is an example. We now have 2 points, one on supply and one on demand. And the vertical distance between these 2 points is equal to the amount of the tax. This simplifies everything, and from this we can determine who pays and how much they pay out of this $1.50 tax on every unit.